This Wall Street investor sell-off on the housing market just got even worse. Blackstone is now taking an $80,000 loss on the house behind me. This is by far the biggest price cut I've seen from a Wall Street investor yet. I'm here about 30 minutes north of Tampa, and this is the fourth house I have now found that Blackstone is selling. And this is a big concern for the U.S. housing market and the housing market in Florida more specifically. A lot of the people who bought in this neighborhood over the last 3 years, they saw their home values go way up because the investors were pushing the prices up. Well, that is no longer the case. In particular,
well, guys, you're beginning to see how Wall Street bankers, because they actually bought incorrectly and overpaid for properties, now you're beginning to see them having to sell those properties, those same properties, at a discount rate now. Now, this is happening in the residential space and the commercial space. So now I got to ask the question, has the real estate reset began? We're going to dive into the topic today, guys. This is going to be really good. Bring your pens and papers. Let's get this thing. You see the thing, baby. Let's go.
Yeah, man, that's crazy. 40 days, God, I've been Swayze. Blew the bid out, that ain't shady. That's a bird, man, I ain't baby. Talking hope out, that's so crazy. How I got a shot, raise the bean sprout up, put a crown up on her head so the boys seeing, no, that's a lady. If you ain't catch a double that time on the last rhyme, dog, I could help you. I got plenty more where that came from when I
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, y'all? It's your partner Dale back in the saddle again for another edition of the Real Estate Friday Live, guys. And today, you've been blessed because it's just going to be your partner today. Cliff's take care of some business today for the family. It's all right, though. You get to see me. So if you could, guys, share, like, and subscribe because you're going to like today's topic, guys. And again, if you get a lot of value out of our lives, guys, that we do, whether it be on the counter move, the real estate live training, which is great. Hey, click on the little bell, guys, so you get alerted each and every time we go live. So let's dive in this thing, guys. Man, there's a lot going on today in real estate. Now, but you know, we do every single time we jump into the current market. Now, you know how we do it every time. Here we go. Yes, sir. Talk about that current market analysis, y'all. Let's jump into it real fast. Yeah. All right, y'all. Let's jump into this thing, man. What's going on with the real estate market right now, guys? Well, we actually have a new president that's getting sworn in 38 days, right? But there's some stuff going on in the market that's kind of iffy. You know, last week, me and Cliff talked about right now the market is really stagnant right now. And the questions that I've been getting a lot of times is, Liddell, do you see us going into a retractionary type of a market, possibly next year, 2025 and beyond? And I did a video that's on my YouTube page and other platforms as well, talking about this. And I believe there's going to be a retraction because of the fact that we're so inflated right now. I'll give you an example. I'm in Dallas, Texas, and Dallas is relatively a kind of what they call a hot market. But typically was kind of hot, although surrounding areas, not so much the Dallas area. You'll look at the areas like the Mesquites or the DeSotos or the Planos, Melissas, the Annas, if you go into the Collin County area. What's been kind of hot a lot in Dallas has been the Mesquite, Box Springs, Forney area. Guys, it is a standstill right now. Standstill. And you see rental rates coming back down because of inflation. Now, why do we say that? People's savings are at an all-time low. Credit card debt is at an all-time high. You also have income has plateaued while inflation is still increasing. Now, you may say, Liddell, but the numbers are something different. Yeah, that's a lot of spin there. I'm really looking at the real world, not what an economist who's wrong 99% of the times is telling you. All right. So we have to begin to be honest about what's really going on. Guys, we're in a stagnant situation now. Do I believe that we're going to have a retractionary event? Yes, we do. It's going to happen under Trump. It is. He's going to try to fight that with going after or cutting regulations when it comes to oil and gas. But yes, it is coming. Yes, it's coming. And the question I have is it here? So what's the analysis right now, guys? It's like it was last week. We have a stagnant type of economy right now. Refinances are damn near gone. You have some here and there, and home purchases. Although after the election, there was some talk about it kind of going up. It quickly got back to real world and began to plateau, guys, because people's DTI are not qualifying for these mortgages, guys. So just keeping it 1,000 with you. That's what's going on, guys. That's what's going to market analysis. Now, if you go to a Florida or California or New York, or New York and California, my God, there's a bloodbath out there. But if you go to Florida, Tennessee, Austin, Texas, those areas, Austin, Texas is really inflationary right now. I mean, it was inflationary 2 years ago. I kind of predicted this really when Biden got elected. I said, wait a minute, this Austin is going to realistically be very overregulated because it was a lot of building going down there. People were calling me for money to invest down there. I said, no, didn't make any sense to me at all. I wanted to see how things were going to pan out, and it came true. So Tampa is going through a big shift now. Of course, you have Fort Lauderdale is inflated right now. Palm Beach is inflated. Miami is inflated. Everywhere else is inflated. And that bubble has to pop. It has to pop, guys. But don't believe me, guys. Let's walk into a little bit of what's going on right now, guys. Now, in the state of Florida, this is not just happening in the state of Florida. This is also happening in other states as well. This is going to tie right into the current market analysis. If you look at it, guys, real simply, we look at it. Let me get the video up. Something happened with Wall Street bankers. Remember back 4 years ago, you had BlackRock. And I'm going to mention BlackRock for a reason, because you're going to see how BlackRock did what they did. And I'm going to give you the strategy of why they did this in a second and how it can benefit you. So, guys, here we go. Let's dive into this real quickly. Here is Wall Street right now. They are liquidating properties at big discounts. And the state he's going to talk about here is Florida. But this is happening all over the nation, right? In areas where these Wall Street bankers came out and paid overpriced for these properties. And now that correction is here and you're seeing what's going on. And I explained how they did it and what you need to know in a second. Here we go. Let's get to it.
New data on the U.S. housing market is showing a surprising increase in homebuyer demand following the election of Donald Trump. In this video, I'm going to analyze the data to see if this increase in homebuyer demand is for real, or if we're going to see buyer demand fall back down and home prices drop in 2025. Because according to Redfin, everyone, U.S. pending home sales rose 12% year over year during the 4 weeks ending November 24th, the biggest increase since May 2021. One reason for the outsized increases that early stage home buying demand, including home tours, boomed in the 2 weeks following the presidential election. Moreover, Bloomberg is reporting that U.S. pending home sales just increased to their highest level since March, indicating that some home buyers have come off the sidelines since the election, and that potentially Donald Trump and his more pro-business, pro-economy attitude could be motivating increased demand in the housing market. And so an interesting question is this a temporary blip on the radar, this increase in demand that was a result of some people who were just waiting for the election to end? Or is it the sign of a more fundamental shift in the housing market where more buyers are going to come in now that the election is over and the Fed?
So now you see a little bit of some excitement post-election. So you see that Redfin is saying XYZ, so this as well. Now let's get to the real world. Now you see it begins to cool off. Now watch what he says here, and then we go over to BlackRock. Here we go.
Fed has cut interest rates? Well, to answer this question, I looked at data on homebuyer sentiment going back all the way to the mid-1970s.
Yep.
So we have almost 50 years of data here. And we're looking at the percentage of Americans that say it's a bad time to buy a house versus the percentage that say it's a good time.
Look at that
And what
percentage.
you can see is that in October 2024, 82% of Americans said it was a bad time to buy a house versus 18% only who said it was a good time.
Yeah.
So we have actually historically bad
Yes.
housing market sentiment right now. We've actually never seen this level of pessimism
Never have.
among Americans about buying houses. Even in the early 1980s, when mortgage rates were 18%, only 79% of people said it was a bad time to buy a house then.
So now what's happening is you see from a buyer's perspective, the buyers don't have confidence in the market. This is even post-election, right? I wanted to go in and kind of give you saw kind of some excitement post Trump being elected, and now reality sitting back in. Now let's fast forward, guys, to what's going on right now with BlackRock. All right, guys, this is what I really want to talk about today because this cuts out all the spin. Right, same company, which is good, and let's walk through this real fast. Here we go.
This Wall Street investor sell-off on the housing market just got even worse. Blackstone is now taking an $80,000 loss on the house behind me. This is by far the biggest price cut I've seen from a Wall Street investor yet. I'm here about 30 minutes north of Tampa, and this is the fourth house I have now found that Blackstone is selling. And this is a big concern for the U.S. housing market and the housing market in Florida more specifically. A lot of the people who bought in this neighborhood over the last 3 years, they saw their home values go way up because the investors were pushing the prices up. Well, that is no longer the case. In particular, on that house that Blackstone is selling.
Notice he said investors were pushing the prices up. That is BlackRock, right? Buying 25% over the asking price, sometimes per house and sometimes for the entire subdivision. That's what they were doing. Again, don't get too upset. I'm gonna let you know how they did it and what their plan was with this. Here we go.
Selling. They bought it in the middle of 2022. They paid $490,000 for that house. They now have it on the market for $415,000 with an entity called SFR Acquisitions 2, which is owned by Home Partners of America, who's owned by Blackstone.
Stop right there. Do you see those companies? So BlackRock, the bank, the funder, funded company number one, which then funded company number two, right? And this is how they're getting the loss. This is what's happening. So BlackRock funded company number one, right? Company number one then funded company number two. Company number two goes out and buys the property. So you have kind of a two-layered tier there, right? With BlackRock being kind of the parent company when it comes from a lending standpoint. Let's keep going, guys. I'm gonna give you the strategy. Here we go.
$75,000 loss. I want you folks to think about that. Blackstone is selling at a $75,000 loss here in a neighborhood called Wesley Chapel, which is about 30 to 40 minutes north of Tampa, maybe a little longer depending on traffic. Why is Blackstone willing to sell a house here in a desirable neighborhood? The median incomes are over 100 grand, according to data on RevenTrap. Why is Blackstone willing to sell at a $75,000 loss? But now I want to show you the problems this is causing for the neighbors here, this Blackstone home sale. We have a lot of homes for sale in this neighborhood. The inventory has absolutely exploded. And in particular, I want to show you one just down the street. Pay attention to this, everyone. This is a house for sale for $412,000. It's a 3-bed, 2-bath. 1,500 square feet. And this owner is pricing it at the same price that Blackstone has on their house, while the Blackstone house is about 800 square foot bigger and has an extra bedroom and bathroom. So there's no way this owner is going to sell this house for $412 with Blackstone on the market for $415 down the street. This house is probably worth closer to $350 based on the Blackstone price. And as a result, if you look on Zillow and the number of saves this house has, it only has 5 saves in the last 30 days. No one's interested. obviously, because the market values here have gone way down. And this shows the power that these investors have to influence values in a neighborhood and to change the dynamics in a neighborhood. When the investors were buying over in the last 3 years in the pandemic, the people in this neighborhood loved it because it caused their home values to go way up. But now the people in this neighborhood hate it because it's causing the values to drop and drop by a lot. And what you got to understand.
So in other words, what he's saying is that is affecting the property values of those homes themselves. So let me kind of explain to you what BlackRock actually did real quickly. Again, let's go back to the example. He said BlackRock owned company number one, and company number one owned company number two, which is Home Partners of America. Know that company extremely well, right? One of my friends' wives used to work there, right? And so what's happening is BlackRock Bank funding company number one was then funds company number two. Home Partners of America, their whole deal is this here, is what they typically do is if you cannot buy the property, they will buy the property and lease it to you in annual terms up to 3 years for you to actually buy the house from them, and you agree to a price point each and every time. That's how Home Partners of America operates. That's how they operate. It's real simple, not hard. Now, why would BlackRock do this? It's very simple. Now, remember BlackRock role is they were the bank, right? They were the bank to company one and company number two. Now, whose banks use other people's money to lend out, not their own. So whose money did they use to overpay for these properties? Not BlackRock's money, the retirees' money. Now, why do I say that before the day? You understand that a lot of the bulk of institutional retiree firms, right? They actually have their funds managed by BlackRock. So yes, your money, potential retirement, police retirement, big Wall Street firms, BlackRock manages a lot of that cash. It was your money. So they used your money to go out and overpay for these properties, knowing that this is going to happen, right? Which means the price points will come back down. And then all they do is BlackRock just comes in with another firm that which they had funded with their own capital and to acquire it for cheap. That's all they just manufactured a discounted sale by using your money. That is the power of a high financial IQ. That's all they did. I'm saying it again. They used your retirement money funneled through two sister companies, two companies that they actually own, to drive down the price point, knowing this is going to happen because they overpaid for the properties 25+%, knowing that it was going to retract and go down to a lower price point, which they'll use their money to go out and buy it at a discount. That's what BlackRock did. And all with other people's money. Ain't that something? That is the reason why this video has been made. It's because BlackRock manipulated the market. Very smartly too. The strategy is very genius. It's genius. Genius. Now, it's good to be talking about this. Don't get mad. Don't get pissed off. Learn how to counter move. It's real simple. That's BlackRock. Now, guys, the next question I got to ask is this question here is, now that BlackRock has done what they've done, what industries in real estate did it affect? Here in the second, guys, we're going to dive right into what industries did this affect, because there is an industry, right? There is a segment of the real estate that actually affects the residential states, and you're going to see in a second what that is. It's going to come from two individuals that you may know, guys, that are masters in this real estate space. Be right back. Here we go.
Okay, so you did fixes and flips first, or were they? Now it sounds like you're more
Wholesale
buying whole. Okay, so you're wholesaling first.
Wholesale
Okay,
because I was broke. I had no credit, I had no money. So I had to get some money coming in. So I learned how to do wholesale.
and you were doing wholesaling at the good time too.
2000.
When it wasn't so saturated. There was.
I kind of saw the debacle coming.
Okay.
It didn't make any sense. I was like, wait a minute, how can you lend out to retail buyers 99.7%?
Yeah.
Just a little bit of a down tick, it's insolvent.
And you got to remember, in some states, because I lived in Florida at the time, you could have loan to value above 100% of your property.
Right.
The first property that I bought, it was 110%. We left the bank with like $30,000.
Yes.
Yeah.
Yes.
It was amazing to me. I was like, why am I not doing this all the time? But then clearly 08, 09 let me know why people shouldn't have been doing that all the time.
No 08, 09. That's why I made a lion's share of my money.
Wow.
People were
Okay.
actually running from the cows. I was running to it.
Of course.
Because I saw it was coming.
Okay.
A lot of my business colleagues back then were buying flippers.
Yeah.
I didn't think it was wise for me to share 50% of my profit with Uncle Sam. He didn't do no work.
Okay.
So why would I give him free money?
Of course.
Okay, how can I make sure I'm still legal, but keep the lion's share of the cash flow?
Of course.
So I began studying the tax code with my accountants and CPAs, and I said, okay, I'm going to buy a whole lot of properties. Now watch this. I actually buy a lot of properties. I take home money when I actually acquire it. Every single time.
Okay, you need to break that down just a little bit.
If you wanted to know how successful real estate investors make money with their acquired real estate and not when they sell it, click on the link below or swipe up and download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed, holla at your partner, and download the ebook today. All right, guys, we are back in the saddle. Now, let's dive into this here. There is one area in real estate that actually controls every segment of real estate. And it's really two areas. It's commercial and residential, right? But one of those two control the entirety of that market, both the residential and commercial side. That is the commercial side because of the sheer size of the paper, right? So let me kind of give you a little bit of example, and I'm going to give you proof in a second. Most banks write more commercial paper than residential paper. Let me say that again. Most banks write more commercial paper than residential paper, right? We're talking about in the billions per quarter. Easy. Well, and there's two segments of the commercial, right? Portion of real estate. You have office buildings, offices, skyscrapers, and stuff like that. Then you also have apartment complexes. Now, why would I bring up those two? Simple, guys. In 2020, a lot of apartment complexes, right, refinanced to a lower rate. But those rates were interest-only rates, guys. Or what they call IO rates. They were interest-only with a 5-year balloon, right? So this is done in 2020. 5 years from 2020 is 2025. We are 2 weeks away from 2025, guys. So a lot of those IO payments, those balloon payments are coming due. But the problem is the equity in those apartment complexes and or the income coming in is not covering, will not be enough to cover the debt service, right? They won't cover it at all. And there's not enough cash to pull out to be able to graduate over to a more friendlier paper because the rates are too high right now. So therefore, if you have an IO payment of, let's say in 2020, you're looking at what, 2 or 3% IO, right? You'll refinance up to 7%, 6%, but the gross rents coming in does not cover the debt service, which is the principal, interest, taxes, and insurance. Doesn't cover it. Didn't cover it at all. So why would you do that at all? And there's not enough equity there to pull out the cash. You pull out the cash, you end up with what I call an alligator. You're losing money and you're not gaining the money. You are paying more is going out than coming in. right? So because of this, guys, I got to ask the question, has the real estate market, as far as the debt service itself, reset? Has the reset began already? Has it begun? I'm going to show you two videos real quickly, right? These are two masters in the commercial space. The first one, Grant Cardone. The second one, Ken McElroy. We're going to begin with Grant Cardone, guys, and we're going to walk through this real fast to let you know why this is happening, right? And the opportunity that this is actually creating, all right? Let's go to Grant first. Here we go.
Warren Buffett says a real estate storm is coming. Over $2.6 trillion of debt looming over the U.S. real estate market. And by the way, Warren Buffett is dumping stock as we speak. He's dumped most of his Bank of America stock. Wow. Should tell you that he knows something that you need to know. So what does Warren Buffett know about the marketplace, the stock market and the real estate market that you need to know? Look, guys, there is a real estate cataclysmic correction happening today.
Right now.
There's $2.7 trillion. And I'm going to share with you how you can take advantage of it, what you need to do about it. But when guys like Warren Buffett and Charlie Munger and Bill Ackman and people are starting to watch this marketplace and say something is going on in the marketplace that's problematic. For instance, we have more unrealized losses in banks today than we did in 2008, 9.
He's saying banks, not properties, the originating banks. Take that in.
And 10, which was a global economic crisis caused again by real estate, which was really a banking crisis, not a real estate crisis. Same thing's happening right now in 2024, 2025, and moving forward. $2.7 trillion
of expiring debt.
Just understand how big this number is. Will expire between now and the dates I just gave you. Today and the dates I just gave you. $2.7 trillion worth of debt is maturing due right now. It needs to be paid off somewhere between now and the next somewhere 20 months from now, okay? That means a maturation or an expiration date on that debt is due. Now check this out. When this debt literally went into place, when it was originated, it was somewhere between 2 and 3%.
Told you.
Okay, stay with me here because I'm going to show you the magnitude of this problem is so enormous.
This is all
and will create such an opportunity for you and your family to actually invest in real estate. And I'm going to show you, based on this, what you should be offering to pay because of that, okay? This loan was done at 2 or 3% today. Let's say this loan matured today. And now is due at 7% interest. So just imagine, I'm going to keep it simple. Let's say it was 3.5%.
So hold on, guys. 2 to 3%. I owe interest-only payments, and you graduate up to 7%. Listen to these numbers.
Interest on any amount, okay? Understand this is going to be thousands, tens of thousands of different loans on properties. It could be an office building, a hotel. It could be apartments like we buy at Cardone Capital. It's not single-family homes. I'm not talking about single-family homes. And the reason—
Notice he said not residential or single-family homes. This is all commercial paper. All of it. This is what's causing the storm. We almost done. Here we go.
I'm not talking about single-family homes in this equation is because 70% of all single-family homes in America have a loan under 4%, less than 4%, less than 4%, every one of them. Okay, 30%, almost 30% of all the homes in America are paid for in cash. So you're not going to have a collapse in the single family. Where you're going to have a collapse and a correction is this $2.7 trillion worth of commercial debt. And I believe that's why Warren Buffett is dumping his Bank of America stock. He has more treasury bills.
Now, what I would say this here is he's correct concerning the collapse not being in the residential from a macro perspective. But what I would disagree with him on a little bit is there's going to be retraction in the residential, not based on, really because of the commercial paper, but really due to inflation. People are not able to afford their mortgage payments anymore. They can't sell their properties. Typically, if someone that can't afford a property or they have to move because of job, things of that nature, they can put it on the market, sell it, and go to somewhere else, right? That's not happening anymore. So therefore, they're stuck with the property. So what do they do with it? This is the reason why there's a certain technique that I kind of mastered that this is it's making a rebound. It's never lost. It never left, but it's making a rebound. And we're gonna go over that in a second. Here we go.
Today, Warren Buffett owns more treasury bills today than the federal government owns treasury bills. I'll tell you why that is today in a second as well. Okay, so watch. Let's say this loan was at 3.5%.
Wow.
And let's say this was let's say this was $100 million hotel loan in New York City or Chicago.
Commercial.
And the loan's due. Great property, great location. It's nothing to do with the property, by the way.
Correct.
The whole problem is the loan matured when the interest rates went up.
Yes, they did.
If the interest rates go up, the loan amount's going to go down.
Yeah,
so they go this way. They basically move inversely to one another,
Yes.
okay? If rates go down, okay, the loan amount goes up. If the rates go up, guess what? It goes the other way, okay?
Correct.
The rates go down. So in this case, what happened was the rates went from 3%
Yep.
to 7%.
Correct.
And what happens to the debt? The debt is going to go down. By how much? Well, by 4 points, okay? In this case, 3.5 points, okay? It's going to go down by almost half. So watch. I'm going to go back and show you the implication on this. Let's say this loan was approved by the bank. This is how all loans are approved by all banks.
Numbers.
It is not approved because commercial real estate is not approved because the guy next door sold for a certain amount of money, like a house does. That's called
Correct.
a comparable, called a comp. Okay, another house sold for 400 grand, so your house is worth 400. That's not how commercial works. Commercial works based on the amount of cash flow generated from that property. So when this loan was done at 3.5%,
Right.
the bank said this loan can support $3.5 million
In
worth of interest
watch these numbers.
on the loan. So the interest must have been less than the total income on the property. I'm gonna make this up because I'm making the deal up.
Sure.
Let's assume then that the free cash flow from the property was $5 million. This would be about what it was for them to approve this $100 million loan at 3.5% interest, this $3.5 million a year in just the interest,
Yes.
okay? We would need about that much to support, I'd need about $5 million to support that. Well, the loan's due now, and the loan went to 7%, and guess what? That's $7 million. What's the problem here? The $7 million comes off the NOI of the property,
Correct.
and they're losing $2 million.
a year.
See the problem? Okay, now,
So yeah, you guys see what the problem is. No, there's a lot of numbers, but if you don't understand what he's talking about, go rewatch this. Now I got to bring in Ken McElroy because Ken McElroy goes in a little bit deeper as well, guys. This is good information, so I implore you guys to watch this. Okay, guys, rewatch it now. Let's go to Ken McElroy again. These are experts in commercial real estate, as we just saw with Grant Cardone. We just saw that the problem when it comes to real estate market is the commercial paper. $2.7 trillion is coming due next year and probably half of the following year, 2026. It's coming due because they secured it, and these IO payments with a balloon in 5 years in 2020. Does that make some sense, guys? So if you walk through those numbers, you can see how the language in that loan kind of made a little bit of a risk now, because people have been counseled, just buy right now, refinance later on. That's the stupidest counsel somebody can never give you. It's dumb as hell. Makes no damn sense. There's so many assumptions in that statement, and you realtors and you loan officers, stop saying that garbage. Stop saying that shit. Tell them the truth. Stop being led by your commission and lead with wisdom. Tell them what's going on. Let the consumer choose. Don't manipulate them by withholding information from them. Tell them the truth. Now, because of all this mess, because of realtors as well as loan officers and also buyers wanting to buy more than they could afford, right? We're in this mess now. This mess. Now, Ken's going to break down loan terms, all right? Understand this again. If you have a pen and paper out, write this stuff down. If you do not, stay broke. Here we go. Let's get it in.
Real estate deals in 2025 will all have the exact same issue. So
Yeah.
every single real estate deal that's in distress has a loan term sheet. And there are 5 main things in the term sheet.
This is exactly what Graham was talking about in the previous video. Watch how Ken breaks this down.
And I've outlined them here. The first one is the term. There's a beginning and an end, and that's going to be very, very important.
Yes, it is.
The second one is the rate. We all hear about the rate, the federal funds rate, and what the Federal Reserve is doing, but the interest rate is extremely important. The type is either fixed or variable. The ones we're going to talk about in this video are the variable loans. The fixed rate debt, they're going to be probably fine. Then the next one is loan to value. So this is leverage. How much will the bank give you against the collateral of the property that you're actually pledging? And the fifth one, which nobody really talks about, is debt service coverage. And this is actually what's disrupting the entire real estate industry. So let's take a snapshot of what interest rates did since 2019.
Right.
So as you guys can see here, they were in the low 4% range in 2019, and they've gone all the way up over 7%. Now they've come down a little bit, but they're basically still, let's call it in the high 6s, mid 6s, to low 7s. That represents about a 3 to 4% interest rate jump.
Correct.
Now, why is that important? It's important because if you bought a piece of real estate in 2021 when rates were, let's say, 3 to 4%,
Correct.
and now they're 7% because you had a variable loan, that means that whatever the loan payment was in 2021 went up a lot. When you first got the loan,
so not only was it interest only potentially, it was also a variable loan, which means it is governed by what they call prime, maybe prime plus 1, prime plus 2, or the LIBOR rate, right? Know these terms, guys. This is the reason why we're going through this type of stuff, so you understand these terms, right? That's a distinct variable that can be dangerous if you don't know what you're doing, specifically in an inflationary happy economy, which is what we end with, rates going up, because the rate adjusts as the rates go up. Do you see how what Graham was talking about, to where now what happens is a $100 million deal, because of the rate adjusting up, the loan amount is going down. What's actually happening is this here, right? Is that deal he was talking about, you end up losing $2 million a month versus you make $1.5 million a month. Because remember, $3.5 million initially, $5 million coming in. As the rate went up, it went from say it's $5 million, but now you're paying out $7 million. That's a $2 million loss. See what I'm saying? Let's keep going.
interest rate would have been 3 or 4%,
Yeah.
but it's gone up each and every year.
Yeah.
That exact same loan could be in the 6-7% range. And in construction loans, it's even higher. The next piece that I want to focus on is what we call the debt service coverage. And this is typically buried inside of the loan document.
Correct.
This is simply the net operating income divided by the total annual debt service. You can calculate the property's DSCR by dividing its annual NOI by the annual debt service, which includes principal and interest. For instance, if a property was generated $450,000 of NOI with $250 in debt service, it would have a debt service coverage of 1.8. That means that there's $1.80 of income for every dollar of debt service. That's really important, that last sentence. What the bank's looking at when they size every loan is this debt service coverage. They look at this as insurance. So what they want is $1.80 of income for every dollar of debt service, which means that the operator should have 80 cents left after that $1 is paid. That's essentially what the debt service coverage means. And as these interest rates went up, it significantly changed the debt service coverages, which I'm going to show you in a minute. Now, it's important to understand that this could be any kind of commercial property. It could be an office building, a self-storage, multifamily, an industrial. It doesn't really matter. In this particular case, it's important to see that it has a $1 million NOI. Now, for those of you who might not remember what an NOI is, it's simply income minus expenses. So in the apartment world, the income would be all the renters paying each and every month, and the expenses would be things like taxes, insurance, and utilities, and all of those things on the expense side. And so it's simply income minus expenses. It does not include debt. That's very important.
Yeah.
So when a bank is looking at what they're going to lend on a property like this, they're looking at the NOI, because essentially this is the net income that they're going to lend against.
Correct.
This is the amount of money that the bank's going to lend you against, because this is how it's going to be paid back.
Correct.
This is a very typical deal, $25 million deal with 75% debt, 75% leverage, or 75% loan to value with 25% equity. A very, very common deal. What this would mean would be the people would tie this building up for $25 million. They would go source the debt at 17.5, and then they would go raise the money or put their own money in of 7.5 million. And of course, hoping that the property produces a $1 million NOI.
Correct.
Now, typically what was going on, let's say in 2021, is these were value adds. So they were raising the money by saying, we're going to value add, we're going to grow the NOI by, let's say, $100,000 or $200,000 in a period of a couple years.
Correct.
And over here, we're going to sell the property for more money than we bought it for.
Correct.
That was the typical strategy.
Correct.
This is a typical value add strategy with an NOI growth from 1 million to 1.1 or 1.2.
Sure.
At
Makes
the
sense.
time in 2021, interest rates were in the 3-4%, let's say. So 4% simple interest. Now, I'm not doing this on a fully amortized loan.
Yes, sir. Simple.
But 4% of 17.5
see
equals a
Gucci.
payment of about $700,000.
You spend it, you look
So
good.
now the bank's looking at this.
Like,
This
yeah.
$1 million is about a 1.3 debt coverage
Yeah,
ratio. In
yeah,
other words, for
yeah.
every dollar of loan, there's 1.3 in income. Exactly
Yes,
like
sir.
the example I just showed you.
Yes,
So this is a
sir.
$300,000 cash flow on this property.
Mhm,
This is about a 4% cash on cash. So what you do is you take your 300,000, you divide it into your 7.5, and that is your cash on cash. And a lot of people look at that because they're like, I can just keep my money in a high interest bank account
Right.
and make 4%. But
Right.
this is what people were doing back in the day because they were trying to create the value and get the capital gain
Correct.
that they were hoping to get. The
Mhm.
debt service coverages were fine here, and the cap rate is 4%. The cap rate is simply 4% into the 1 million NOI, which equates to a $25 million value.
Correct.
So that's how that works. Now, the cap rates, they do move based
You
on
do.
the values of property that move from year to year to year. So cap rates go up and down based.
Now, the reason why we're going through this, I know this is a lot of numbers, guys, but I want you to understand why we're in a situation that we're in right now when it comes to real estate, right? How the commercial is affecting the residential. I want you to understand this real quick. And Ken does a phenomenal job unpacking this. Here we go.
On what people pay. So, and based, of course, on what the NOI is.
Mhm.
So you'll see cap rates going up and down. So typically cap rates are quite low in markets that are super competitive. You'll see the higher cap rates in markets where there's not as many buyers, and you'll see the lower cap rates where it's super competitive. So now let's go to 2024. And the reason this is important, because in the first slide, I showed you that every loan has a beginning and an end. And so in every kind of value add property, people typically took out about a 3-year bridge loan with
Told
2
you.
1-year extensions.
I told you.
So let's say this was 2020
Told
or
you.
2021.
Yes.
2024 would be about the 3rd or 4th year.
Yep.
So maybe they expired, they had a 1-year extension.
Yep.
But now things are a little more disruptive, as
Yep.
we all know.
Yep.
Interest rates went up to 7%. So this is the first thing to note.
Yep.
So they went from 4% to 7%. So right out of the gate, what that does is it raises your payment from $700,000 to 1.225.
Yes.
That's, again, just simple interest. That's
It's
just
simple.
having the interest rates go from 4 to 7% on the exact same loan amount.
And we ain't talking about, guys, we're not talking about any tax or insurance. That's just the interest payment. That's all it is, because this is an interest only loan. No, nothing under the principal, zero. No taxes, and nothing escrowed, no insurance. This is just the interest payment post the increase in the interest rate. Here we go.
This is the biggest issue that you're going to see as a theme as to why these properties are in distress.
Yes.
Hopefully you are immediately seeing that this property now has about $125,000 negative cash flow
Correct.
a year.
Alligator.
So we went from positive $300,000 cash flow to a negative $125,000 cash flow.
It's a
This
420.
is a red alert for the bank.
Yes, it is.
Now, what I also want you to note is that the person who got this deal and bought this property, actually did raise the NOI. They actually did increase the net operating income. So they were able to do it by, let's say, $100,000 or $200,000. So this is all positive, but it immediately was lost because the interest rates went up from this period to this period.
Exactly.
So what they've done, even though they've performed,
Yeah.
is that the interest rates have wiped away all their progress.
Exactly.
And so now they're in a negative cash flow situation.
Yes,
So the
sir.
lender is now taking a look at this loan and saying, holy cow, this property now is in jeopardy. We are out of bounds with the debt service coverage piece of the loan terms. That's the
Yes,
first thing.
sir.
There's no cash on cash, so your investors are upset. It's a negative cash flow situation. So this sponsor, these people that own this building, they either have to fund this out of their pocket, they have to go get another partner, they have to go to their existing partners perhaps and get more money.
Yeah.
And they're trying to do anything and everything they can
Yeah.
to save this deal.
Correct.
So this is the state of many, many commercial real estate deals right now. Doesn't matter if it's office, self-storage, new construction, multifamily with bridge loans, it doesn't matter. But this is the debt maturity issue that's facing us right now, and it's going to hit in a big way in 2025. Now let's go to the end.
So stop right there, guys. Again, phenomenal breakdown from Ken Mackwell. Phenomenal. Everything I said, he came out and said, guys. All right. This is kind of the really first time that I kind of saw that all the way through, but I knew what I was going to say because I've read Ken McElroy's books. Right. So now let's go back to Grant real fast, guys. You may say, well, Dale, this is a lot of doom and gloom. Man, what's the yeah. What is the bounce back counter move to this? I want you to hear to your partner, Grant Cardone, and I'm gonna give you another one in a second so that you can see what's going on. Here we go. This is this because of this chaos, right? That was really created by the banks and the bar. Both of them actually have some type of co-equal thing. Now, the question I was going to ask is this here: is the bank knows that this is going on? Why would they write this loan? Simple. Because the bank makes fees for writing these loans. Now, some commercial loans are underwritten by the government. Some are. One of my good friends actually works for the government in their commercial lending division. Yes, some loans are insured by the government. So those type of loans, the banks are okay with doing those loans because they have a takeout partner called the government. Some they do not. Some they'll put into a mortgage-backed security. Sound familiar? And place it on the market to begin to be traded. And you better believe these credit default swaps are still going on. That's the reason why these banks did this, because they had a parachute, someone to bail them out, whether it be the government or private companies via the stock market. That's why they did these type of loans. Now, of course, they want the loan to perform great, but they know they have a backup plan and begin bailed out, right? Let's keep it going, guys. We're almost done. Here, because of this stuff, this is the type of opportunities that's going to come up. Here we go.
0.0825. A loan.
Oh, here we go.
For $48,480,000 on this deal. Okay? They have a loan right now of what? $100 million. Lose $52 million. The seller's probably going to lose 52 plus 30 or 40 that they put down on the first deal because they put money down to buy that deal.
So here is what. Let's go back.
That number, the $4 million.
Grant's finna break down real quickly, guys. That $100 million example he was talking about, what you would be able to buy this distressed property at. Watch this number. Remember, $100 million is the loan amount, right, on this property. Watch how much of a discount you get for this distressed property. Here we go.
$4 million, and you're going to divide by 0.0825. And it's going to tell you that the lender is going to give you a loan for $48,480,000 on this deal. Okay? They have a loan right now of what? $100 million. Yeah. That means somebody is going to take a haircut on this deal, $52 $52 million. The bank's going to lose $52 million.
Yep.
The seller's probably going to lose 52 plus
Right.
30 or 40 that they put down on the first deal because they put money down to buy that deal. When you do this, it determines what you can pay for the real estate. And that is how you guys are going to take advantage, and probably why Warren Buffett, by the way, is stacking up all this cash, okay? See, because we have I just took $100 million out of this. That's 100 million out of these numbers right here. I still have 2.6 trillion, $90 billion worth of debt if I just take one hotel out of the food chain. That's what's coming due right now. This is going to be the greatest real estate correction in my lifetime. This is the opportunity for you and your family to go out. When you understand these numbers, when you simplify these numbers, when you understand not just what you want to pay, but what the bank is going to lend on
this money.
When you go to that bank and say, look, man, I can't get a loan for more than $48 million. That's all the lender is going to loan them this deal. Why? Not because of me, because the property only produces $5 million. Not me. That's the property. Bottom line is, what's happened here? Somebody paid $130 million. That's probably what they paid for that piece of real estate. They probably put 20 or 30% down when they bought it. They paid $130 million. And the next time it trades, guess what? It won't be $130 million. It's going to go from $130 million to $49 million. By the way, that's going to happen 27,000 times in this cycle. 27,000 times. If I only buy 1%, why I'm so excited all the time, everybody's like, why is Grant Cardone so excited? Why does he got so much energy? If I only get 1% of this, I'm going to buy 270 deals. Jeez. Is that right? Yeah, 270 deals. 270 deals. Yeah. I own 51 deals right now and have $5 billion worth of real estate. If I end up with 270 deals, 51 divided by 270, oh my God. I'm going to get so rich, it's going to be crazy. I'm getting excited. You see what's happening to me? Times 5.1 billion. I'm going to have $26 billion worth of real estate.
Yeah.
This is the greatest real estate correction in my lifetime, okay? And it's going to benefit somebody. This is going to happen. It's going to happen to somebody somewhere. It could be in Fargo, North Dakota. It could be in Fort Lauderdale. It could be in San Francisco. It could be in Singapore. It could be in Cincinnati. It could be in Chicago. It could be in Houston, Beyonce town. It could be in New York City. It's going to be somewhere. That piece of property was $130 million. Next time it trades, it's going to be $50 million. Somebody's going to make $80 million. Now, last thing I want to say about this is this. This is what happens. This property value goes down. Why? Because rates went up.
Exactly.
When rates go back down again, guess what happens? The property value goes back up again. Somebody's going to buy it for 49, sell it for 100 or 130 million. They're going to make 80 million because they were in the right place at the right time with the right amount of confidence. If you
That's it, guys. Guys, that's the bounce back, guys, man. It is more than ever right now. Let's remove this video real fast, guys. More than ever right now. This to me is the greatest time in history to invest in real estate. The most powerful strategy moving forward, guys, is going to be joint venture partnerships. Right? In the residential area, yes, I agree with Grant when it comes to you're not going to really see a huge correction in the residential from a depreciatory standpoint. You'll see a little bit, but not as much as the commercial because of the sheer paper volume of it. But you're going to see a lot of creative financing deals going through. One of the greatest techniques that I've been able to master by God's grace was just making a comeback, and it never left, but it wasn't talked about. It wasn't the sexiest strategy. Is subject to investing. That strategy is coming back with a vengeance because people are not going to refinance from a 2 to 3% interest rate and go up to a 7% interest rate. They won't do it. Doesn't make any sense at all. No one's going to, if someone comes and wants to buy that property, the residential property, they're going to want a little bit of discount because they can't ask for it because you can't sell it. You can't sell it because the buyers don't want to originate a 7% loan. Like, guys, I looked up FHA loan, guys. 7.1%. To be precise, 7.125%. If you can go below to about 6.25%, but you're at 7%. FHA. Probably one of the most safest loans for a residential buyer. Safest loans from a LTV and a down payment standpoint, and also a rate standpoint because it's insured by the government. Just letting you know what's going on, guys. Subject to investing is going to be off the chain, and also being able to locate distressed properties, guys, is never gone out of style. It never has. But most people only want to buy retail properties, which to me is the dumbest thing I heard in my life. I like buying properties on sale, don't you? I love that. So this is what I'm saying here, guys. This is the reason why I'm giving away a free ebook. It is free. It's called Distressed Property Investing. How you can locate a distressed property, whether it is a apartment complex, commercial, office building, storage facility, warehouse, you name it, in your city, county, state, right? Be honest with you, right? If I could teach you how to locate those deals, vet the deal the right way, guys, and structure it the right way, we can joint venture partner together and I'll fund the deal for you, right? And we can profit share together. I'll be your bank for you. No problem with it at all. The reason why is because I agree with Grant. This is the greatest time in history to acquire real estate. That's the reason why I want to give away this book for free. I don't want your money. I want to give you the knowledge so we can get the bag together. Right? Together, guys. It's not hard at all. And in this book, we talk about a technique for you to get a list of distressed properties in your city. And you can also do it in the county too, right? By making one phone call. One phone call. And you can get the list for free or for a small fee, like $100. Nothing serious at all. Easily, guys. Again, I want to give away this ebook for you. I want to give it away to you. All right. I've gotten DMs from individuals, had phone calls with individuals that actually want me to acquire some land. I've located land in Texas, in other states as well. Also, I've gotten deals coming to me from New York. And I'm like, don't know about New York, but I'll take a look at it. Sure. Of course, I'll be killing it over there in Mississippi. This killing the game. I'm a mid-tier town investor, right? That's me, because I can get these properties for damn near nothing. Damn near nothing, guys. Easy, guys. Click on the link in the description, right? Or scan on this QR code, or direct message me the word. DM me the word real estate, not in the chat. But direct message me that word real estate, and my team will get you out this exact same link, guys, so you can download this ebook. It is completely free. I don't want no money from you at all. I'm literally giving you for free. Now, you may say, Dale, I don't want to get into real estate, but I do want to look at something from a business standpoint. No problem. Your partner got you. Again, a friend of mine by the name of Mike Sapala, 7-figure earner, and with this business model, actually walks through 3 business models that you may already know, right? That can generate a passive income, or that you may not know that you may generate a passive income, right? Which is fine. And that third one is going to surprise you on what it is, guys. That third one, guys, you're gonna be like, what? Yes, you can generate a passive income that can pay for bills, that car payment, that house payment, that school tuition payment, you name it, it can actually do that for you guys. It's simple. Just easy to go to the description and click on the link, and it's a free video. It's free. You can watch the video or scan on the QR code, which is fine. Or what you can do is you can actually DM me the word passive income, and that exact same link will go out to you. And lastly, guys, don't you get it twisted. Yo, man, I got my merch, baby. The merch is looking real fresh, cold, clean. People are buying the merch, y'all. Yo, man, go get you the bag merch, baby. You can get you a hoodie, a hat, a t-shirt, whatever you need, your partner got you, y'all. It's real simple. Easily, guys. What you can do is there's a link down in the description, or as also, you can also scan on this QR code and get your merch today, guys. And lastly, guys, every Thursday, man, your partner does a counter move podcast, guys. It is kind of blown up a little bit, man. People are loving it. We talk about anything at all, guys. Let me kind of give you a little bit of a sneak peek of what that is, guys. Here we go.
Why they party? I'm in here grinding. Money I'm stacking. Why they rock diamonds? I can't relate to them. Ain't my shit common. I set a goal for me 2 or 3 commas. 7 figures, 8 figures to 9 figures. On a slow pace to get rich quick. Same time we just think different. Cause when you make it, it hit different.
Guys, that's the Counter Move podcast every Thursday at 8:30 p.m. CST. You can catch your partner talking about something. The Counter Move process. We're talking about strategy, capital, and impact. That's what it is. Strategy, capital, and impact. It's real simple, guys. Well, guys, thank you so much for your time. This has been a long one, but I think it's been a good one, right? For you guys to be able to kind of dive into this, man. This has been very fun. Extremely fun, guys. But guys, thanks for your time. God bless you. I hope you have a good weekend, guys. You know, I ended every single time before you leave them while you can, baby. You see that thing, baby. Take that damn picture, give it to your mom and them. Highly partner. God bless you guys. See you next time. Peace.
Bless God, give thanks. Whoa. Bless God, give thanks. Bless God, give thanks. Whoa. Bless God, give thanks. Whoa. Big God, big